Okay. Good afternoon, everyone. I'm happy to be here with all of you. By means of introduction, it's basically exactly what he just told you. I've spent my career in SBA lending. My first job was with the Small Business Administration, and after that, I have managed SBA lending departments in small and large banks in the Mid-Atlantic region. I was the first woman to serve as the chair of the National Association of Government Guaranteed Lenders, where I have also been the chair of their Technical Issues Committee and have been a teacher teaching lenders how to do SBA loans. And when I left the corporate world and joined multi-funding, I switched my passion for teaching from teaching the lenders to teaching the entrepreneurs. And I actually still do teach lenders. That keeps me on top of all the rules and regulations, which we need for running multi-funding. So we're happy to be with you and happy to share what we do. Multi-funding is a financial advisory service. We specialize in SBA lending and assisting entrepreneurs in finding and matching them with the right lender for their project. We truly believe that for business acquisitions, and that's the way that a lot of entrepreneurs choose to grow, the best way to do so is through acquisition, and the SBA loan product is one of the best out there in order to accomplish a business acquisition. It is not simple, but it's not as hard as everybody makes it seem. We're going to go over everything, but we're here to introduce ourselves to all of you and let you know that our services are free to you as the entrepreneur. When we assist you in getting an SBA loan, it is the bank that pays us, not the entrepreneur. So if you are doing an acquisition and you're looking for SBA financing, I hope you'll remember us. In the meantime, we can be a resource to you at any point along the way. So let's get started. Our poll questions have a little bit of a technical glitch, so we're not going to actually be able to answer them. But I would assume that most of the people on this particular call are already existing business owners, and you're interested in understanding how you could take advantage of the SBA loan program to purchase another business. There's no other conventional loan product out there that would allow you to borrow 10-year fully amortizing loan, a fully amortizing loan other than the SBA 7A loan, when you are purchasing a business that does not include a real estate asset. You know, banks are looking for, on a commercial lending side, they're looking for full collateralization of the loan. And SBA is not looking for that. So you can get up to $5 million in an SBA 7A loan. And there are other banks, there are certain banks, and we know who they are across the country, that will do another 2 to 3 million more in a side-by-side loan with the SBA loan, and would allow you to still utilize the SBA product for a bit larger than a $5 million loan. Oh, I just wanted to interject here that we have a very nice size audience on here today, and I'm thrilled about that. But because of the number of people, I'm going to go through the entire presentation before we start answering questions. I would love if you guys would put your questions into the chat so that when you think of it, you actually are able to ask it, and then I will be able to answer all of your questions at the end of the presentation. We'll have time for that. And also, if we don't get to your questions, we will send them out to you in an email blast to everyone who's registered. So during the time that I'm speaking, it will be a better sound quality if all of you keep your microphones muted, okay? And then just put your questions into the chat And at the end, we'll be able to speak to you and if you raise your hand and so forth. So let's just continue with why SBA is the best option for you. Okay, my first question was going to be true or false. The SBA lends you money in the form of a 7A loan. Is that true or is that false? Well, the answer is that it's false. The SBA is not your lender. The SBA guarantees a certain percentage of your loan to the bank. The bank makes the loan that it would otherwise not be able to make based on its conventional lending policies, but with an average of a 75% guarantee, it does entice the banks to make loans that they ordinarily would not do. Okay, the Small Business Administration has standard operating procedures that every single bank has to follow in order to get an SBA guarantee. The SOPs, the standard operating procedures, give the lenders the minimum requirements in order to get a guarantee. Every single bank, and there's about 2,200 banks across the country that participate with the SBA, they add their own slant to this. So each bank that does SBA lending does not necessarily do it exactly the same way. There's a baseline minimum, but some of them add their own requirements on top of that. And because of this, we suggest that you look for an SBA preferred lender when you go to do business with an SBA bank. Make sure they're a preferred lender. That means they have experience in SBA lending, and SBA has granted them that status where they act unilaterally on behalf of the SBA. This will cut your processing time in half, if not shorter. Okay. Also, SBA preferred lenders do more SBA loans, and they can be more comfortable with doing deals that lack real estate or other significant collateral. As I said to you before, each bank adds on their own slant to the SBA program. So if you go to a bank and they tell you that you do not qualify for an SBA loan, this may or may not actually be true. You need to dig deeper and ask them why you are not qualified. And then you should get a second opinion. Or you can come to multi-funding up front, because we know what the rules and regs are. And we know when the bank is telling you you're not qualified, we'll know whether you're really not qualified or you're just not qualified at that particular bank. And preferred lenders understand that. So when you ask them, they should be able to tell you, well, you might be able to get an SBA loan from another bank, but just not at our bank because of XYZ. Okay, the next topic we're going to talk about is what type of collateral do you need to get an SBA loan? We're talking about a business acquisition here, and usually the largest percentage of the loan is going to go towards goodwill, intangible, blue sky, whatever you want to call it, but you can't wrap your, excuse me. Please make sure that your microphones are muted. I'm getting some background noise. Thank you. Okay, because acquisition deals lack the collateral, banks do not, on a conventional basis, usually want that exposure. Okay, but SBA loans are cash flow loans. They're not based on collateral. Remember, the SBA is giving them a 75% guarantee, which means that if, God forbid, the loan goes bad, the SBA pays the bank 75% of the then outstanding principal balance. And that serves as collateral, okay? SBA loans used to purchase non-real estate assets have a 10-year maturity with no prepayment penalty. And for business acquisitions, SBA will lend up to 90% of the total project cost for you to acquire this business, okay? Any individual with 20% or more ownership of the borrowing entity will have to personally guarantee the loan. And in most cases, be willing to give personal collateral for the loan. If the loan is under $350,000, the personal guarantee does not have to be secured with personal assets. If the loan is more than $350,000, SBA's fully secured rule comes into play. And what that rule is the loan needs to be qualified up to the amount of the loan. And if there's collateral available, they will take it, but they will not decline the loan for lack of collateral. Okay. And there's certain states in the country where you're not allowed to use the home as collateral, where they operate under the Homestead Act. And then SBA obviously won't take personal collateral. But again, they won't turn you down if you don't have collateral. And that's SBA. I'm not saying that there's not certain banks that will turn you down, but SBA doesn't require that. Okay, what are the terms of this loan for you to buy a business? What interest rate do you think you can get a 7A loan at? 975, 1050, 750, 825. Well, this is always a fun one to see where the group thinks the SBA loan rate is. But in general, for a business acquisition loan that is not secured with real estate, SBA will charge 10.5% today, because SBA rates are based on prime plus a spread. And generally the spread on an unsecured or not fully secured loan is 2.75% over prime, which is right now at 10.5%. You might be like going, ooh, 10.5%, but it's not the interest rate that you need to be worrying about. It is actually the payment, okay? Let's talk about how to use the SBA to acquire a business. Here is a scenario. Say there was a business for sale with a purchase price of $2 million. The earnings before interest, taxes, depreciation, and amortization for that particular loan is $500,000. The buyer, or the buyer's business that's buying it, has $500,000 to put towards this acquisition. So their first option is to go to the bank and try to get a conventional loan. With a bank on a loan like this, you would need no less than 20% down, or 400,000 of your 500,000 cash available, leaving you a cushion for working capital or unforeseen expenses of $100,000. The loan would be for 5 years and probably at 8.5% interest, which is less than the SBA loan, and a monthly payment of $32,826. Okay, that's the bank loan. An SBA loan, on the other hand, you only need 10% down, or 200,000, which leaves you with a beautiful cushion of $300,000. Yes, the interest rate is at 10.5%, but the loan is for 10 years, bringing the monthly payment to $24,288. Wow, that sounds very nice, if you ask me. But then there's also the option of using a line of credit and seller take-back financing. In this case, the seller is willing to take back $1.5 million in financing, and then you can use $500,000 from the line of credit on your existing business, assuming you have it, and your payments would be interest only at 8.25%, or $3,437 a month in interest. But remember, you're paying interest only. At some point, you're going to have to come up with the 1.5 million to give to the owner. So what would you choose? A, B, or C? The bank loan, the SBA loan, or the line of credit. Now, here's the time where I'd love to know which one you would choose, but I can tell you, some of the people are going to choose the bank loan because they can't get comfortable with the interest rate. Some will choose the line of credit because they don't want to put any money down. And then some people would like the SBA loan with the lower payment, even though the interest rate is higher. Well, at multi-funding, we do not believe that the best use for a line of credit is to fund long-term capital assets or investments. You need to match the term of the loan to the life of the asset that it is financing. Lines of credit are really supposed to be used to level out cash flow, to support working capital needs, inventory, accounts receivable. Often you could use a line of credit for an emergency or for seasonality in your business. That's what a line of credit is for. It's not to use one big chunk of that line of credit for an asset that's going to be on your books for a long period of time. So let's compare the bank proposal and the SBA proposal. If you're looking to buy a business, in this case, the difference in the down payment is $200,000. The bank loan would be for 5 years. The SBA loan will be for 10 years. Now, the bank loan may have a 10-year amortization, but it's going to have a balloon at the end of 5 years, going to be back in the boat looking for financing again. The bank loan is at 8.5. The SBA loan is at 10.5. Then there's $100,000 of your capital left in the business on the bank loan. Whereas with the SBA loan, you have $300,000 of cash for working capital or any unforeseen events that take place as you're starting this new business. And the payment comparison, 32 versus 24, that's a significant amount of money each month that would be required to go out of the business at the beginning of your life with this new business that you own. So obviously, I'm much more in favor of a lower payment versus a lower interest rate. You go to sleep at night easier knowing that you can pay the $24,000 instead of saying, oh, woe is me, I have a 10.5% interest rate. That's not going to make you sleep well. So we ask you, which monthly payment would you rather have if COVID struck again? 32,000 or 24,000? And remember what I said to you, that the SBA loan does not have a prepayment penalty. And if the business is doing really well, then why? So remember, you're purchasing a business that has cash throw off, 500,000. On the conventional proposal, your annual debt service, I need to move this because I can't read this. The annual debt service is 366,000. And on the SBA loan, it's 256,000. That, my friends, is $110,000 difference. And that can make or break your new business acquisition right there. So look at the difference in the payments, not in the interest rate. Remember, it's the payment that you have to make. So on this deal where you're looking at, you know, a loan that which we were describing, you know, that was a huge difference in the payment. Even at 350,000, there's a $3,000 a month difference. And the higher that you go, the bigger the difference is between the 10-year payment and the 5-year payment. So we don't really think that there's anything to decide here. When you buy a new business, and there's certainly unknowns, you'd rather have the smaller payment and know that without penalty, you can pay more if things are good. You can pay it off if you want without penalty. And the other real true advantage of the SBA loan is the amount of money that you have to put down. And SBA's minimum requirement is 10% down. Now, there's plenty of banks that want the owner to have more skin in the game than 10%. But there are plenty of banks that will do 10% down. The SBA does not allow the use of borrowed funds for the equity injection. They want the borrower to have unborrowed funds. If they were going to allow you to borrow it, they would lend it to you themselves. They want real skin in the game. Okay. What are other options if you don't have the cash yourself? Bring in an equity partner, someone who's going to come up with some of the money. But remember, anybody that ends up owning 20% or more will have to personally guarantee the loan. And if the loan is greater than $350,000, they may end up having to pledge personal collateral. So if they're truly just an equity partner, you want to keep their percentage ownership below 20%. How else could you raise the money? Well, you can get gifted funds. So maybe your rich uncle said, you know what, I was going to leave you this money in my will, but now that you're starting this business, I'll gift it to you. But remember, if you do get gifted funds, the gifted funds have to be proven that there is no repayment attached to it. So there has to be a certification from the giftor stating there are no payments that will be required on this particular gift. Now, there is also a way to utilize the funds in a 401k that you happen to have, not through active employment. If you're actively employed, you can't use that 401k. But if you have a 401k from a previous employer, there are companies out there that can roll over the funds in your 401k to give you the equity contribution that you need to purchase the business. You would need to form a C corporation with those funds, and then that corporation would be borrowing the money, but the basis, the cash would already be in that C corp from the rollover. There's two companies that come to mind right away, Guided Financial and Benetrends, who have a lot of experience doing these rollovers so that individuals can raise the money in order to purchase the business to get to that 10%. But what about the seller who's willing to help you with the down payment on an SBA loan so that you can get the loan? What do you think? Do you think a seller take back would be something that would be helpful? Well, my reaction to this, if I didn't know better, would be no. SBA says no borrowed money for the down payment. But I would be wrong, because the truth is you can use a seller note for half of the required down payment if that seller note is on what we call complete standby, meaning there are no payments of principal or interest due for the entire life of the SBA loan. That is what standby means. They're subordinate in every way to the SBA loan, and no payments can be made for the entire life of that SBA loan. And the SBA says that the seller can have a standby note for up to 1/2 of the required equity. In most cases, it would be 10%, so the seller note could be 5%. Okay. Now, if the seller wants to finance more than part of the equity injection, or they don't want to finance the equity injection, but they're willing to take back some of the financing on the loan, sometimes they want to do that because of the tax ramifications of taking in all the cash at once, or because they just want to make things easier for you so that you'll be able to get a loan. The seller is not required to take back any of the loan as far as the SBA is concerned. But a word to the wise is the terms of the seller note are really going to be dictated by your lender, because the seller's note and the terms and the repayment of that have to be included in the lender's debt to worth calculation and in their debt service coverage ratio, which means that as they look to see if not only their SBA loan can be paid, can you make the payments that are going to be required on the seller note? Besides the fact that the bank generally does not want the seller to be paid off prior to the bank being paid off, but they will, in some circumstances, allow the seller to extend a 10-year note, which has interest-only payments for the first 2 years while the business, gets on their feet, or maybe a 10-year amortization with a 5-year balloon. It's known that once a lender makes you a loan to purchase a business, and as long as your loan is performing, if you have made payments to the seller for 24 months, be it interest-only payments or principal and interest payments, at that point, the SBA allows the bank to come in and refinance the seller's take-back note. Now, they can't ever refinance the standby loan that served as equity, but SBA will allow the lender to refinance a seller take-back loan if the payments have been made on time for 24 months. Now, we were talking about the acquisition of another business, but when does SBA consider the acquisition of another business to actually be an expansion of a business, and therefore not have the 10% requirement for the 10% down? An existing business that acquires another business that will operate as a separate entity, that can be considered an expansion when both businesses, meaning the existing business and the one you're going to buy, are in the same industry and have the same NAICS code. After the sale, both businesses will be owned exactly the same way, the same people, same percentage ownership, and the existing business and the business being acquired will be co-borrowers on the SBA loan. Now, if all three of those are true, SBA does not consider it an acquisition. They consider it an expansion, and there is no need for a 10% injection. So if you're a rental business and you're buying another rental business, you very well may be able to do that with no money down based on the cash throw off of both your businesses and your ability to service the debt that you're about to incur from the acquisition. This would also apply if you, the same owner, wanted to start another business in a different location that would be in the same industry with the same ownership, and you'd be willing to be co-borrowers. That would also be considered an expansion versus an acquisition without the requirement for the 10% down. And then remember that these are business loans. They're not personal loans, okay? The loan is based first and foremost on the business that you're buying. You as the owner are secondary to that equation. It's the business that you're buying that SBA is interested in determining that that business throws off enough cash to service the debt of the purchase price, okay? Which businesses are most financeable in the eyes of the SBA? Well, because we've said time and again during this presentation that SBA is a cash flow lender, they will look at the historical earnings before interest, taxes, depreciation, and amortization of the business that you're buying. They will look at an average of the previous 3 years of tax returns to see if the business can pay the debt service on the loan that will be extended for the purchase. And they will look at the current year financials as well as the last 3 years of tax returns. They want to make sure that it's currently operating at the same levels that it was, if not better. Okay. The key is to show historical cash flow that can service the debt. The banks will look for ways to mitigate risk when there isn't 3 years of historical cash throw off to service the debt. Okay, they'll become creative. It doesn't mean that you can't buy a business that has not been in business for at least 3 years. SBA will look, and the lenders will look at newer businesses, but they have to look more closely to make sure that the repayment ability exists. So, you know, when you're looking at the earnings before interest, taxes, depreciation, and amortization, what other expenses are going to go away when you buy the business? So what are the expenses that are tied directly to the exiting owner? Travel expenses? Maybe yes, maybe no. Won't the new lender need to do the new owner need to have travel expenses? What about meals? Was the owner paying for Saturday night dinner out with his wife on the business, or were they really meals associated to, you know, traveling for the business? Owner's compensation is a big add back if the buying owner has another source of income to take care of his personal needs. SBA has owner eats first rule, making sure that the owner has significant enough income to support their lifestyle. Depreciation gets added back. Entertainment expenses, maybe yes, maybe no. Interest expense gets added back. Automobile expense, were you paying for the automobile of the wife of the owner, of their children, things that won't need to continue? Any expenses that are easily provable, that adding back because they will no longer exist. If you can prove that from receipts, or that's basically what you need to prove, and that they're non-recurring expenses, then you will be able to add them back, but they have to be easily provable. Okay. And then what about how much are they going to lend you? What is the business that you're buying actually worth? So a third-party business valuation is going to be required by the bank on the business that you're about to buy. And SBA will never lend more than the official valuation of the business. Remember, a third-party business valuation is similar to an appraisal. It will be ordered by the bank for the bank and paid for by you, the borrower. You cannot utilize the business valuation the seller did or one that you, the buyer, did, unless the goodwill is less than $250,000 and the business is not being sold from close relatives, or it's a partner buying out another partner. In other words, if it's an arm's length transaction under $250,000, then you do not need a outside business valuation. But most of the businesses that you are dealing with, the largest percentage of the selling price is going to be allocated to goodwill, and an outside business valuation is going to be needed. Okay, so this is when you have to get it, when the goodwill exceeds 250, if it's not an arm's length transaction, or if the lender thinks that it's not reasonable for whatever reason they believe, they can ask you to get, or they can order a business valuation on the business that you're about to buy. Are you allowed to buy part of a business? Can you buy into a business? In other words, oh boy, I don't know what this is all about. Hold on a second.
For the present, Lynn. Oh.
I don't know what happened to my slideshow. All of a sudden it disappeared.
So go click on
Here
your
it is.
screen.
Here it is, right? Can they see it now or no?
No, we can't.
Okay.
So if you
Share
go back
screen.
to your Microsoft
Here it is.
PowerPoint.
Yeah, I got it. And this is it. Can they see it now?
Yes, then click slideshow and
Yeah.
from current slide, the second one, that one.
There we go. Thank you. So sorry, everyone. I'm a little technically challenged. Can you buy part of a business or buy into a business? And the answer is no. The seller is only allowed to stay in your business for 1 year at the most on a consulting basis. And the SBA is going to require a non-compete. Actually, it's the lender that's going to require the non-compete. And in general, I have found that most lenders want the seller to sign a non-compete for the life of the loan. They are also probably going to ask you to obtain employment agreements if there are key employees to that business. In other words, the key top salesman of the business or something like that. They may ask you to get an employment contract with that individual to assure that they're not going to go anywhere and that the business won't be able to operate at the same level. How much financing is available if you're going to buy out your partner? Well, the answer is you can get 100% financing to buy out a partner. Okay. There are certain requirements to do that, and I'll tell you quickly what they are. You have to have been in the same ownership percentage of the business or more over the last 2 years, and the business cannot be leveraged more than 9-to-1. And if those two things exist, SBA will lend you 100% to buy out your partner. And this tip here, don't quit your day job. So without ongoing outside income, so in other words, if you don't have income from your existing business, the bank is going to be looking at putting compensation for you, the new owner, into the business. And sometimes they add in more than what the existing owner was taken. The bank looks at your monthly obligations from your credit report, and they often add a percentage to that. And then they give you an owner's compensation that they take out of the business. That's the owner eats first rule by the SBA, right? So your owner's draw, even if they put it in, it doesn't diminish the value of the business, but it does affect the cash flow available to service the debt. So why on this previous slide, we said, don't quit your day job. It's really beneficial if you do not have a source of income outside of the new business you're about to purchase that can handle your personal living expenses that perhaps, you consider not quitting your other job. Or I might say, if you have a spouse who makes an income and you don't have to take an income out of the business, they could possibly ask that spouse to sign on as a guarantor. And as such, even if that spouse does not own any of the business, if you own real estate collateral jointly and the loan is not fully collateralized and it's over 350, the spouse may be required to sign what's called a limited guarantee to limit their interest in the real estate that would have to be pledged for the loan acquisition. Okay. All right. What about the loan maturities? Okay, the loan maturity. We talked about the fact that SBA would do a business acquisition loan for 10 years, but sometimes you're looking at a business where the real estate is being sold along with the business. And if that's the case, and the real estate comprises more than 51% of the actual purchase price, you can get a loan for 25 years to buy out that business, a 7A loan. If there's real estate involved and it's less than 51%, you could get a blended rate that would take the maturity beyond 10 years, but not as far as 25 years. The only problem, it's not necessarily a problem, the only condition is once you get an SBA loan that is 15 years or longer, there is a 3-year prepayment penalty. So it's called a subsidy recoupment fee because the fee doesn't go to the bank. The fee goes to the SBA. If you pay the loan back in the first year, there's a 5% prepayment penalty. In the second year, there's a 3% prepayment penalty. And in the third year, there's a 1% prepayment penalty. But if you wait till the fourth year to pay back the loan, there's no prepayment penalty at all. And if the loan was 10 years or less to begin, or less than 15 years, you wouldn't have one to begin with. So that's the end of my prepared comments. And I would love for you to either raise your hand or write questions in the chat. And we have, the remaining time to answer all of the questions that you have concerning SBA lending or SBA lending for an acquisition or anything that I said that may be confusing or you'd like me to repeat. We've put up the contact or way to connect with multi-funding. And I'm sure that you're going to be able to get copies of the slides that we had today, and you could call or write to us and ask the questions, but I would love it if somebody would ask a question now. I don't know if there are any questions in the chat or anybody would like to unmute themselves and ask me a question. That would be fine. Any questions? Allie, are there any questions in the chat?
Not at the
This is
moment.
Mark Spranko. I could ask a question if you don't mind.
I'd love it. Ask away.
I bought another building a year ago and I have a laundry facility in what's left of my old building. And the expenses that are going to be required to install a laundry facility in the new building have grown as more than doubled. And I don't have the cash because I'm on my third draft design with the city. And I have to install an entirely new drain system, sewage system on the one side of a building. And what I budgeted about $30,000 is now going to be about $125,000.
Oh boy.
So
Yeah.
since I really don't, obviously I could take money out of my 401 or whatever and, bite the penalty. I'd rather not. Is this would my situation? And what I also want to do is put new equipment in there. Now, if I'm going to do it, I'm going to take half the equipment, move it, and then buy some brand new equipment, which might be another $125,000. So it could be as much as a $250,000 update.
Do you already own the building?
Yes, I do.
Does the business take up 51% of the square footage?
So the business, I own the entire building. So
Okay. You own the business and you want money to build out your laundromat with your laundry business with new equipment, correct?
yes.
That is an eligible request. And that type of request is not, is it a new business that you're starting or a second location?
Actually, I I own two buildings. The one building that is a sales office also has a 12,000 square foot warehouse that is laundry and kitchen only. And the laundry and kitchen was going to be transferred to the new building, which is about 40,000 square feet. And what I'm going to do is I'm going to hit hopscotch. I have 6 or 7 pieces of equipment operating at the first location, and I want to just get the other operation up and running so there's no hiccup in the operation itself.
Okay.
So
And
so my
then in
laundry
the end, will
customers,
in the end, will you all be operating in one location?
yes, ultimately, yeah.
Yeah. Well, that's certainly an eligible SBA request.
And
Absolutely.
would that be considered an expansion on those parameters?
Yes.
Okay, I thought so. All right, where do I sign up?
Okay, really, I am serious. You can email me after the group at lozer@multifunding.com, or you can call our office and make an appointment to speak to any of our advisors.
Okay, that would be great. Thank you.
You're welcome. Thank you.
Hi, Lynn.
Anybody?
Can you hear me?
Yeah, yeah.
Hi, I was thinking of a scenario with some key employees and offering them some ownership in the company as kind of my pre-entering into semi-retirement. Is that something that SBA will look at?
Financing their buy-in?
Correct.
No.
Okay.
That is not something that they would do. Now, SBA, the best scenario for a business acquisition that we've seen, total business acquisition, is when an employee or employees of a business go together to buy out their employer, because they have the ability and the knowledge to continue running the business at the level that it's been run at. Their salaries are already in the business. You as the owner, everything that is attached to you goes away. And as long as that business can afford as long as they can get together and come up with the 10% down payment that they would need, then they can buy out the business with 10% down. Now, if you wanted them to be able to buy the business with no money down, then you should grant them stock ownership, or charge them, but they can't borrow the money from the SBA to own a certain percentage. And in 2 years, they will be eligible to pay you whatever the business valuation is of the business. The 100%, they'll be able to get 100% finance. So you can plan for your departure. And so existing owners of a business, a partner buyout, can occur if the partner or partners buying out the business have had the same percentage of ownership or more in the last 2 years, and the debt to worth of the company does not exceed 9-to-1 at the most recent fiscal year end and the most recent interim. If those 2 conditions exist, then those people can buy the business from you for 100% of the purchase price with no money down. So you'll get all your money all at once. Or, they can get together and buy you out, and you could, lend them half the down payment in the form of a standby note for 10 years. And then they can buy the business from you.
Okay. That makes
But
sense.
we're happy to talk about this with you and help you figure out how to do it. I mean, knowing what their financial condition is and so forth. But I will tell you that you're a step ahead if you sell your business to an employee that knows your business. Because when a lender goes to make a loan for a business acquisition to someone that has actually been in that business, It makes it so much easier.
Makes sense. Thank you. I
You're
will
welcome.
I'll be in contact.
Great. I look forward to hearing from you. Do we have anybody else who has a question? I see maybe, Ally, are there questions in chat?
Yes, so Rhoda is asking, doing the math, it seems like the total payment over 10 years, over the 5 years on conventional loan is nearly 1 million more. Stated as a question.
I didn't, oh, because of the amount you're paying on interest. I don't know what the exact amount is more. I didn't do the math. But yeah, over time, yeah, you will be paying more on the SBA loan, absolutely, because you're paying more interest. But, you know, the truth is you get in there and after a couple of years with your own management running the business, if you're throwing off enough cash to service the debt, you may be able to go in and refinance it. But it's getting that first loan that is the most difficult. So yes, I understand your reluctance to pay that much more money over time, but it depends how long it takes you to be in a position to get less expensive finance. It's very difficult to get a 10-year loan or even a 5. I mean, if you have 20% down, you're still not going to be fully secured. If you have 20% down and you're fully secured, you will be able to get a conventional loan for less money. Go for it if you can get it. It's just that most people, when they're buying a business like this, where a large percentage is goodwill, they have a difficult time obtaining conventional financing.
All right, we
there-
do have more questions in the chat. Jen
Sure.
is asking, what about just buying equipment for a new business?
You can buy equipment for a new business. Absolutely. SBA does all sorts of loans. The only time SBA has a required down payment is when you are starting a business, meaning the business is considered a startup for loan purposes by the SBA when they've had less than 12 months of revenue, still considered a startup. Then you need to have a 10% equity contribution for any loan that you get. But if you've been in business and you just want to buy new equipment for your business, you can get an SBA loan for 100% financing. Absolutely.
Thank you. What
Sure.
about, because they're like little kiosks, and so it's probably fine. Actually, I answered my own question. Okay,
Okay,
thank you.
sure. Ally?
All right, so John is asking, I understand SBA loans are for companies physically located and operating in the United States. If a company outside the United States wants to enter the American market, would they be able to qualify for an SBA loan with a new USA Corp?
No. In order to get an SBA loan, the owner of the business, 51% or more of the business has to be owned by a United States citizen or an alien with a green card, a 551 registration. If 51% or more of the business is not owned by a US citizen or a green card holder, they cannot get an SBA loan.
All right, Kurt is asking, could you please explain the 9-to-1 example?
Certainly. When I say that business is not leveraged more than 9 times, what we're talking about is total liabilities of the business divided by the equity section, the net worth of the business divided by the liabilities is not more than 9-to-1. You can't have more than 9 times of the debt to $1 of the equity. Okay, that's the debt to worth ratio. You take the liabilities divided by the net worth, and that's your leverage. And it
All
can't be
right.
leveraged more than 9-to-1. That's what we mean.
Okay, we have another question from Mark. Mark is asking, What would be the average turnaround time for a SBA expansion loan?
I love that question, Mark. We get it every time we make a presentation. I wish I could give you an answer and say it will take X amount of time, but I can't tell you that. There are so many variables that go into this. It depends how well and how, far along you are in the negotiations with the seller. The buy-sell agreement has to be at least in draft form for the process to begin. You need to get the last 3 years tax returns from the seller and a copy of their interim financial statements, plus the last 3 years financial statements on the business that you already own and your personal financial statement, you and anyone that owns 20% or more of the business. So yeah, that's the initial gathering of information to make the determination. And then depending on whether you're buying real estate, we may have to get a real estate appraisal. There may be environmental requirements for those particular scenarios that would change the timing tremendously, because those things take time. A business valuation takes time. So all these things add up. Not that some of them can't be done simultaneously, because they absolutely can be, but it's very, very difficult. So if you said to me, Lynn, what's the average time? Well, if it doesn't include real estate, you can probably get it done in 90 days if everybody is cooperating. If you have a cooperative seller, cooperative buyer, but otherwise it can take longer than that. I've seen it take anywhere from 90 to 180 days, depending. I will tell you that if you find a bank that is interested, it can take a lot less time. I mean, if you are shopping the deal yourself and you don't understand all the SBA ramifications and you have to wait until you get an indication from this bank to go to another bank, it may take longer. If you let us help you, it could help speed up the process, because we only work with preferred lenders. So there's ways to make it shorter, but each scenario is going to be different. When you submit what you do have, we may be able to give you an approximation of how long it'll take. I'm sorry, I don't have a better answer. I wish I did. Allie?
There are no more questions in the chat.
Okay. Does anybody else have any questions? Okay, I hope that you will connect with us if you're thinking about buying a business, and allow us to help you do so. And feel free to reach out and contact us and ask any questions. And I really appreciate your time.